Hey everybody, it's James here. I'm at the airport with Cynthia right after Mogul Mastermind. As coincidence would have it, we're on the exact same flight to Vancouver. So we figured we'd do our Q&A at the airport just because it was the perfect time to do it. So first thing I wanted to say was, Cynthia, thank you again for coming out to Mogul Mastermind. We really do appreciate it. We got so much positive feedback on your presentation.
Awesome, good.
And a ton of questions came in. The first question that I asked, and this was inspired by a conversation I had with one of the guests, was you made a comment that really resonated with me, that if you said if something doesn't make full sense to you, if you don't fully understand the investment, then maybe you shouldn't invest in it. But I was talking to someone who is on the other end of that spectrum with the analysis paralysis, where it's almost like they over understood it, but they're just scared to make the jump. So what kind of advice would you give to somebody who is trying to figure out if they've understood it and they're scared, or if they just legitimately don't understand it?
I think the key to that is that you question to avoid, which I mean not avoid in the sense of not understand it. You question till you have a complete understanding of what you need to know to make the decision. And part of what I find with investors that are unsatisfied or disillusioned is that they didn't get all the questions answered in advance.
Okay.
And so that's I think the other path that I always go on is be very clear on what your objectives are and what you want to do. And if you are, then that means that you'll be passionate, you'll be driven to get the answers, and you'll ask the questions that need to be asked. And that path and that what is my success story has been sort of what's driven me to success investing in real estate. And I've gone a number of different ways, but I had a certain goal, and I also had a path that I defined, and what I would do and what I wouldn't do. So the question part of understanding something is really being clear on the investment. And if you're really clear on the investment, and that's what your path is, you'll make the decision. It's mostly people, they don't know what they want to invest in, so they may understand it, but that's not really what they want to invest in. So you may see I always say if someone's paralyzed and doesn't make a decision, there is an underlying objection to why they're not doing it, and it's not related to not understanding it.
Yeah, I would agree with that. Well, that leads into the next question that I would have is, what are some of the best questions you can ask about an investment when you're doing your due diligence?
Tell them, it's when they write papers, they say to write to a grade 4 level. Have a complete understanding or a complete description or explanation of exactly what you're investing, as though you're talking to someone that's in grade 4. And it's not like we're trying to dumb it down. It's because that forces the people that have created these complex or these, intricate, especially in private equity investments, so that you clearly understand how you're going to make money. And that's really, if I can understand exactly how to make money, and I believe, and there's rationale behind the business plan, then it makes it a lot easier for me to invest.
Totally. So it's almost like, if you're looking at a complex investment, try to explain it to your child who's in grade 4 and see if they get the bare bones of it.
Exactly. And that's really where I go. If you don't understand it, it's because someone hasn't dissected it now, so you understand the business plan and you understand exactly how you, the investor, are going to make money.
Totally.
Because that's why you're investing, is to make money.
Well, I have a question that leads in from that for our number crunchers out there. We see these nice financial models with lots of numbers in there, and different people have different ways of putting together their spreadsheets, but what are some of the commonalities that we see in these financial models where you should really look for this and look for that, and what are some red flags to watch out for in a lot of financial spreadsheets that you see?
There's just ratios and rules of thumb on fees to be charged, and when they should be charged, and when they start. So is it upfront fee? That's soft costs. Those are costs that fall off the table before any money goes into the investment.
Got it.
So your whole capital's not being invested. So what is that ratio? And it's different for different investments. I'm not going to give a rule of thumb for this. You can only have so much soft cost, which is administration, financial, legal, fees, administration fees that are being paid on any investment.
Like salespeople commissions are in there too?
Sales commissions, finder's fees. So you want to look at those, measure them against a like investment. So pretty soon if you have, what are my soft costs? This is a fund, and all of a sudden I'm seeing, These guys charge a lot of fees, so more money. Now, then you would compare. The next thing is, what's the management? What's the business plan?
Right.
But how much money are you investing that's actually going into the investment? Is really a really good one to start with, because it'll weed out the people that are they're all upfront fees. Now, in this day and age, it's very competitive, and with automation and computers and spreadsheets and easy access to it, I think that the people that are raising a lot of money and the good businesses know that. So they're very competitive in their fee structure.
Right. And one of the things that you talked about in your presentation is the technology that you guys are developing. We know that everything is going to be more tech-enabled. Like in our industry in real estate, it's the tech-enabled agents who are still being successful. In your industry, you've created this tech platform to allow people to manage their investment portfolio. Can you talk a little more about that? Unfortunately, the volume wasn't quite loud enough for the people.
I know, that's right. So, I mean, we've posted it on our YouTube, so I can send you a link so they can watch it and understand it.
Sure, we'll add the YouTube link to the description of this video.
Perfect, awesome. So the technology platform is the way, my vision is, number one, to get people to have all of their investments, whether they're real estate, whether they're stocks and bonds, whether they're private equity, all in one spot, so that you're looking at your pot of investments. Then you can run reports. So the first stage is really just bringing it all together and having it easily assembled and easy for people to input. That's our first stage. Then we can do our deals, and we can also do the analysis of those deals, and ideally in the future allow people to create their own way of analyzing that deal that works with how they feel and think. That's where I think it's kind of like what I talked about, the Netflixing, the Fitnance, because I might only want 11% return, but I really don't like certain risk factors. My tolerance is a lot less than mine. I have a high risk tolerance, especially in real estate, because I know real estate, so I'll make decisions where most people go, wow, that's a big decision, and I'm a higher risk tolerance because of my understanding. So the goal behind the platform, baby steps, we're going to get it so everyone can put all their stuff in one place. And then we're going to start layering it with reporting, eventually customized reporting. And a lot of it will be layered with artificial intelligence, which, it's here now. So here's what my goal would be, is if people get their portfolio in there, they actually see what they're doing. In real estate, I think you're probably experiencing this. If I have lots of clients that have bought buy and hold. So every year their mortgage is being paid down. But they don't really look at that. Their payment's the same, and if the cash flow's going down, what can they do? So they go to renew their financing. And they're like, what should I do? Well, I take a look at the market and say, I want my clients to not, and depending on their personal situation, some people don't care, I'll run more negative cash flow. Others can't really afford to do that. So, for example, we're in Fort St. John. The market we know, we feel very comfortable in that market. We've got some hiccups going on here, but long term, we believe it's the right place to stay. My clients have weathered some, poor cash flow years, and now they're coming up for refinance. And I'm saying, look, go requalify, extend your mortgages, drop that payment. And so that you can weather this longer period of time, so that you're not digging into your pocket. For some of my clients, some of my clients say it's fine. I will carry that cash flow the way it is. So that would be a report that I want to have my clients easily get.
Totally. So if I'm hearing you, there's going to be two parts. It'll help people understand their portfolios, but it's also going to help edge people along to become more a sophisticated investor, because, I like the word that you use, risk. Investing is that great equalizer where every time you see a higher percentage on the projected ROI, there's a risk factor that gets added to the investment some way. And sometimes, someone who's trying to put their best foot forward in an investment isn't going to, brag about the risk factors. They're just going to brag about the additional return. So part of what you guys are going to do is really make sure that there's a good risk-reward analysis, so people can pick the investment that's actually the best for their conversion.
I think with real estate in particular, there's no measurement of it on the three things: the cash flow, the mortgage pay down, and the appreciation. So it really doesn't get measured fairly when it gets compared, and that is probably why real estate hasn't been as big a part of financial portfolios. The movement I'm seeing is that people are recognizing it is a powerful wealth builder. So people want to invest in it, but to take all those masses that are used to mutual funds with net asset values every day, stocks that go up and down, that there's a measurement of value. If we can move real estate into the same space, I think it'll fare very well. And that is another goal, because for me, real estate's made my money.
Yeah.
If I would have relied on investing in the stock market, I'm not saying that lots of people haven't made lots of money, but they're students of it, and I'm not.
Yeah.
And so for us in the real estate side, I want to measure it, I want to show people, and I want people to make decisions on, how to allocate properly.
So I think that's fantastic, and I really, really like the technology platform. I've had a chance to demo it a little bit, and I even in version 1.0 it looks fantastic, so I can't wait to see the extra features get layered on top
Yeah,
of it.
it's beta test right now. It takes time. Like I said, baby steps. You're going to get it so it runs smoothly and seamlessly. A lot of it's to do with our input of clients, because we have the Know Your Client, which is a beautiful form. I think even on a real estate side that's not in the exempt market space, to capture that information on your clients will give you a whole bunch of opportunities to partner them up with experts like mortgage experts, or tell them what to do to maximize their equity. It's going to help everybody, even on the side that isn't in our space, which is, it's called Know Your Client. Everyone should know their client. If you're in the advisor business, whether it's real estate, stocks, bonds, debt financing, anything, people should know who they're dealing with to be able to give them proper advice.
Yeah, that makes perfect sense. Now, one of the things I find people learn a lot from are stories. So we know that in this kind of exempt market space, the low double digits, low teens is what we're aiming for, and what a lot of companies who are very successful, like the ones you work with, have been producing year after year. But what are some, and we're not going to name names of companies obviously, but what are some stories of these types of investments going horribly wrong, where somebody had the best intentions to make double digit returns and this particular project or this particular company just crash and burn? What happened?
Well, I mean, there are some examples out there that were well-established companies that had been in business for years, but they were in a very cyclical investment environment,
right,
and they weren't diversified within their asset class, and they stuck to one geographical region that had a big problem. And so all of a sudden, all of these investments that were doing well, if the cycle continued to climb, and even in a recession it wasn't bad.
Yeah.
But it's typically in real estate, anything development.
Yeah.
Anything development, land development, anything like that you're not you're actually having to create value through either rezoning, developing houses. Like, those are the highest risk, because so many things can go wrong.
Totally.
And if you're you're not spread out where you have a system of buying in different geographical regions, you're really exposed to the region you're in. And if it's in a downturn, and an extended downturn, then that can be horrific. Yeah. So my whole thing about suitability, you shouldn't have more than 10% of your net financial assets in any issuer. So that will protect you against this type.
Yeah, I love that you use the word diversity, because often in real estate, investors just get so focused on one thing. There's definitely the philosophy out there that be an expert in your target neighborhood, or be an expert in your target city. But there's this movement towards diversity as traditional financial thinking starts blending with real estate, and you're absolutely right. You don't want to put all of your eggs in one basket. So when you say to have no more than 10% in any one issuer, would you say it's best to diversify based on geographic locations, or what the companies are doing, or what are some different ways that you can diversify in real estate?
I think it's more an asset class.
Okay.
Because if you're in, and again, it's really, you have to look at what clients already own.
Yeah.
So a lot of my clients own a lot in BC, because that's where they live. That's just normal with people that invest in real estate. So is it, should we keep piling money into it? If you believe in the region and you really have their strong fundamentals, you might want to diversify into a different asset class in that region.
Right.
Self-storage.
Yeah.
Student housing. You might want to do that as part of your diversification, or you may want to go to a completely different region and do what you know best.
Yeah.
It's the assessment and what I don't have a problem with people saying, getting really focused, I'm going to buy single-suited homes. I'm going to buy fix and flips, because that's their expertise. That's what they feel comfortable analyzing. So I would say then they should geographically move across.
Right.
To not be all in one spot.
Keep a strategy that's their wheelhouse, but diversify the location, so they have different markets, so they're not, like you said, everything is in one market that then gets hit with a cyclical factor.
And also what I would really think about is to me, we look for issuers that have that skill set, that are laser focused, They execute on a business plan that they've developed. It's proven. They have track record.
Right.
I look for that for the issuers, and then I pick those issuers for my clients.
Got it.
Because most of our investors are passive investors. They're not do-it-yourselfers.
Right.
They have day jobs. They work hard. They make good money. They want to invest it in real estate, but they really don't want to have all the. They don't want to do the stuff around.
Yeah.
So
yeah. As we know.
and it depends on your client base. For you, it might be different. You might have people that really want to get that house and do the suite, and you know, and that's what they want to do, and that's all great. That's the beauty of real estate. No deal is the same.
Yeah. Yeah, you're absolutely right. A lot of our clients are the more active style ones. They're flipping, they're building, they're property managing, they're putting in the tenants. So it's awesome to have this conversation because it's two different types of investing, more active, more passive. But I think there's definitely space for, you know, all of you active investors out there. Diversify. Don't forget to put some of your, you know, your rainy day money in something that's a little more passive, so you can focus on your active business.
To Toronto.
And I think
All customers should now be
coming
on
to
board
the
through
event
gate
with the
52.
RSP,
Yeah.
and you can invest directly, as we heard.
Yeah, you don't have to put RSP money in, by the way.
Right, but the other thing is, for people that have RSP money and like real estate,
Yeah.
what are your options? And I think that what Andrew McCready was talking about,
Right.
you know, you can lend yourself money, and there is an institution that'll do it. And that is a great way for someone who wants to kind of, if it's an investment property, not your principal residence.
Yeah.
So there was just nuances around that. So there's other options to use your RSP, and I think that it allows people, I mean, I have a lot of clients that just, the mutual fund route doesn't work for them anymore, and they just really want to get into the real estate side. So there's some options there, and you don't have to make as much to still make as much,
Yeah.
because it's inside and it's tax deferred.
Yeah, exactly. I'm going to ask that question next because we were talking about the math of the power of an RRSP portfolio. So, you know,
This is
one
the
of the
final
comments you made
boarding
was
call
when it's in an
for Air
RRSP, it
Canada,
actually
Flight
increases the
162 to
ROI because
Toronto.
of the tax implication. Can you
All
explain that?
customers should now be on board through gate 52.
Okay, so if I'm in the top marginal rate,
Yeah.
and I put money inside my RSP, it's protected from my taxation. So even if I earn 7% interest inside my RSP,
Right.
I keep the 7%.
Exactly.
Whereas outside of my RSP, I keep 3.5%.
Yeah, because you're paying tax on your gain.
Right. On your income or your gain. So the most tax effective way to be taxed is capital gains, because only half of it's taxed at your marginal rate.
Exactly.
Inside an RSP, it's all deferred. So your money gets to go. The TFSAs are also an excellent source because there's the ability to pull money out.
Right.
So it's not locked in for long term. So for older clients like myself,
Mm-hmm.
I put my money in my TFSA to shelter it, and when
Yeah.
I need it, I can pull it out. I don't, you know, it's a little bit more flexible. So it really depends on where you're at in the stage
This
of
is the
investing.
final
Totally.
boarding
Well,
call
and,
for
you know,
Air Canada,
if you have
Flight
the ability to do
162
both, they're
to
both
Toronto.
really, really great ways. I mean,
All
you
customers
know, it's great to
should
make
now
money.
be on
It's not so
board
much fun to
through
pay
gate
tax.
52.
But it is great to live in one of the best countries in the world. So I feel like we get what we pay for, but that's a whole other
It's
story.
not a bad problem to have.
Yeah.
If you're paying tax, it means you're making money.
Well, that's always what I say when my clients ask, how do you know? I don't want to pay tax on my rental income. I say, you know what? It's better to pay tax on money you're making than to pay zero tax on having $0.
Right. But there's also strategies around that.
Yeah.
And that's where you work with a great mortgage broker that understands how to set up a HELOC, you know, do the cash damming through the Smith maneuver.
Right.
And, you know, if you're in a top marginal rate, it can be very, very effective. I mean, that's how I accumulated a lot of wealth just by buying and doing that strategy.
Right.
And saving taxes while I was making money. So you need to work with the people that understand it. You need to set it up properly. You need to be bulletproof. You know, CRA always looks for real estate investors that are doing things wrong, and then so you got to be careful.
Yeah.
But you know, there are people that are very solid in setting them up.
You know what? You touched on something called the Smith maneuver. And I think that'll be our last question because it's such a cool little tidbit. Can you just explain the basics of the Smith maneuver so that people know what we're talking about?
The basic of this: if you have a principal mortgage, you're paying interest on a large amount of money, and it's non-tax deductible. The Smith maneuver allows you to set up a line of equity or a credit line against your home and borrow to invest, which you can deduct all the interest. Any income from that investment, you use to pay down your principal mortgage first,
Right.
and you borrow again to pay the expenses of the rental. It's called cash damming, and it's just how the money flows. It's not like your debt's going away, it's just you're changing the debt from we call bad debt, which is non-deductible interest on that debt, to deductible interest on that debt.
Right. So now you get a tax advantage for paying down your principal mortgage by moving the money through the flow.
Right, and that's the key. The key is you need to set up the structure so it's very clear and there's no muddying of waters. You're not using some of that line of credit for personal, because
Right.
that will totally, like, you would be audited and you would lose all the benefit and probably experience penalties. So I caution people that are thinking about it, it's not a do-it-yourselfer. Find a mortgage broker that can set you up, set up your program, pay them to do it. It's worth every penny, especially if you have large principal residence mortgages and you're making, even if you're making $50,000, $60,000 a year, you can save significant amounts of money in tax.
Huge, yeah, it's a huge accelerator. Okay, well, Cynthia, thanks for the Q&A. I really appreciate it. I think that's answering a couple of the questions that I had during the networking break. Were there any other questions that people came up and asked you that you think are good for everybody to hear the answer to?
No, they really like the success story, and they really like the approach to the
This
success
is the
story.
final boarding
Everyone is
call for
different.
Air
It's
Canada,
not about
flight
wanting to retire rich.
162 to Toronto.
That's the first thing pops.
All
Oh, well, I just want to have a lot of money when I
customers should now be
retire.
on board through gate
Not
52.
necessarily. Everyone has different objectives, and if you really find what your objective is, it gets you very clear path.
Yeah.
So, yeah.
Tous les passagers doivent déjà être
Well, thank you so
embarqués.
much.
Thank you. Thank you,
Yeah,
James. It was
well,
awesome.
we'll see you on the plane.
That's right.
Okay, thank
Enjoy.
you.